You briefly touched upon management, ownership in the 19th century and the 20th century of corporations. Why has there been no accountability, basically, with this whole financial crisis that's caused such damage across all aspects of the economy to the present day?
Well, I say there are many aspects of this, but one aspect is this problem of corporate governance, which has gotten much too little attention. That this separation of ownership and control, which means that the irony in this whole debate is there are a number of ironies. One of them is that those in the financial sector often talk about the importance of incentives, incentive pay. The first point about that is that if they understood incentives, they would have understood that the incentive structures were designed to encourage, as I said before, short-sighted behavior and excessive risk-taking. Before the crisis, I was, as a professor, I was a little bit worried because the one thing economists agree on, we don't agree about a lot, but the one thing that we do agree on is that incentives matter. And if you look at these incentive structures as they're written down, you would say the economy is headed for a wreck. And so it was a little bit embarrassing before the crisis that we hadn't had that wreck. But now we can go on, leave our textbooks as they are, because we were headed for a wreck. The incentive structures led to the bad behavior that we had predicted. But the second thing is that while that's partly true, it's also true that a lot of this language about incentive pay is really dishonest. It's really a charade. And that was brought home very forcefully by what happened at AIG when many of the other banks. What happened was that when there was no bonus, in incentive pay, you're supposed to have pay based on performance. But when there was no performance, what did they do? They changed the name of the bonus. So it went from performance bonus to a retention bonus. But they got the same bonus. So it's there, and the point to realize is if your pay doesn't depend on your performance, then it's not performance pay. The only thing that depended on performance was the name of the pay, not the actual pay itself. And it really undermines the fact, that it was less incentive pay than it really claimed to be. There's actually a very important implication of this that I think is, in a way, very troubling, which is that one of the justifications for the high pay and the high degree of inequality in our society is that it's necessary to provide motivation, to provide incentives. But if you look at the pay, and it's unrelated to performance, then you have to ask the question, what is really going on here? And what is going on is the point that I mentioned before, that there really has been in many parts, not all parts, but in many parts of a corporate, a separation from ownership, between ownership and control.
Does it set up when the U.S. government prevents a couple of large banks and auto companies from failing, but lets hundreds of smaller banks and tens of thousands of businesses to go bust?
Well, that's a softball question.
I think the audience wants a hardball answer.
No, I mean, obviously, one of the things I say in the book is that what we've done is created what I call air sacs capitalism, where you socialize the losses and you privatize the gains. And obviously, if you're socializing losses and privatizing gains, you don't have a good incentive structure. That incentives are totally distorted. And then that's, all the propositions, all the theory about why market economies work are based on a system where there is accountability. accountability at the individual level, accountability at the organizational level. And when you do what you just described, you've totally undermined that kind of accountability. What they said, and this is by both Bush and the Obama administration, was that they needed to save the banks in order to save the economy and to get credit going again. That was the argument they gave. But in fact, they not only saved the banks, but they saved the bankers, the shareholders, and the bondholders. And that was really what was undermining, what I believe is undermining capitalism. In response, there were alternative ways of doing it. And Obama at one critical point said, looking at examples in Sweden, Norway, many other countries, he said, that's socialism. We don't do things that way. But what he forgot was actually what we did with socialism, in a sense, because we were socializing the losses. And that in the United States, we should have been playing by the rules of capitalism. We did that in the case of Continental Illinois in 1984 when it went bankrupt. A very large bank, the sixth largest bank, we let it go bankrupt. And what does that mean? What it means is that ordinary rules of capitalism, if you can't pay what you owe, the shareholders lose everything, and the bondholders become the new shareholders. They bear some of the losses. The basic point is the shareholders and the bondholders are supposed to be the first lines of defense. In the case of Citibank, there were $325 billion of long-term bondholders that could have put in the money before you turned to the U.S. government. We protected them, and that was wrong. Now you can say, a lot of people saying, well, things are better, we've gotten repaid a lot of them, we may even make a profit. We'll get repaid, but not necessarily, or almost surely not in a way that would compensate us for the risk we bore. And markedly, the result of this is that our national debt is much higher than it would have been had we played by the ordinary rules of capitalism. Or put another way, if we had provided capital on the kinds of terms that Warren Buffett provided capital to Goldman Sachs, we would have hundreds of billions of dollars more in our national bank account.